What if renting is actually the smarter financial move? For years, it genuinely is. Jake and Marcus started in exactly the same place. Same salary, same city, same $60,000 saved. One rented, one bought. And for the first 6 years, the renter was winning. But 30 years later, one of them owns the roof over his head. The other is still making monthly payments just to stay inside his home. So what happened? And more importantly, which one looks more like you? Jake and Marcus have known each other since kindergarten. Same schools, same generation, same starting line. Marcus buys a 3-bedroom house close to work, $300,000. He puts 20% down. That wipes out his entire $60,000 savings account immediately. Then comes the mortgage, 30-year fixed, 6.5% interest. His monthly principal and interest payment lands around $1,517. Add taxes and insurance, and Marcus is close to $1,900 a month before maintenance even begins. Jake rents a similar place nearby for $1,400. No down payment, no closing costs, no roof, no plumbing, no maintenance. Instead of buying a house, Jake puts his $60,000 into an S&P 500 index fund, averaging roughly 8% annually. On paper, Jake looks smarter immediately. His housing cost is $500 lower every month. Jake goes out more, travels more, sleeps lighter. His friends joke that Marcus bought himself a second job. And honestly, some days Marcus feels like they are right. One weekend disappears into yard work. Another disappears into fixing things that somehow always cost more than expected. Jake watches football on Sunday. Marcus watches YouTube tutorials about plumbing. One Friday night, Jake gets invited on a last-minute trip to Miami. He books the flight in 10 minutes. Marcus stays home because the water heater started leaking that morning. Jake or Marcus? Which one are you right now? Drop it in the comments. That difference matters more than people think. Renting feels lighter because responsibility stays external. Ownership pulls responsibility forward. Meanwhile, Jake's investment account keeps compounding quietly. No emergencies, no contractors, no repair invoices. After 3 years, his $60,000 investment quietly grows to around $75,600. And Jake did nothing except leave it alone. Marcus, on the other hand, is dealing with closing costs, taxes, insurance, and maintenance. Closing costs alone hit around $9,000 on day one. In year one, Marcus pays roughly $18,200 toward the mortgage. About $15,400 of that goes straight to the bank as interest. Only around $2,800 actually reduce the loan balance. That interest disappears exactly like rent. The bank collects it, it builds nothing. Nobody just calls it rent, but that's exactly what it is. By year 3, Jake paid around $50,000 in rent and still has a growing investment account. Marcus spent dramatically more, but built less than $10,000 in real equity. Right now, Jake still looks smarter. Then something changes. Marcus gets a notification. His home value increased, and this is where leverage quietly enters the story. Marcus invested $60,000, but controls a $300,000 asset. That means appreciation happens on the entire property value, not just his cash. Historically, U.S. home prices appreciated around 3% to 4% annually. By year 6, Marcus's house is worth around $369,000. His mortgage balance has dropped to around $221,000. Quietly, almost $148,000 of equity now exists that did not exist before. That's the hidden engine behind homeownership. Leverage. Marcus is earning appreciation on a $300,000 asset, not just on his $60,000 down payment. Jake's $60,000 investment by year 6 has grown to roughly $95,000. That's real money. But Jake only earns returns on the money he personally invested. Marcus earns appreciation on the entire property. Think of it this way. Jake's money works at 1 speed. Marcus's money works at 5 times that speed, because appreciation runs on the full asset, not just the down payment. And over decades, that difference becomes enormous. Jake gets another lease renewal, 4% increase. He shrugs. Could be worse. And that's exactly why rent increases are so dangerous psychologically. They almost never arrive as a crisis. They arrive as small monthly increases that slowly become permanent. $1,400 becomes $1,456, then $1,514, then $1,575. Jake barely notices the first increase. That's the problem. Financial pressure almost never arrives all at once. It arrives slowly enough that you adapt to it, until one day, your housing costs doubled while your salary didn't. Marcus, on the other hand, keeps making the same mortgage payment, $1,517, year after year. What felt expensive in year 1 starts feeling normal by year 10. By year 20, it almost feels cheap. And rent never stops. There is no finish line. Jake's $1,400 rent growing at 3.5% annually becomes around $1,870 by year 10, around $2,500 by year 20, and over $3,300 a month by year 30. Marcus is still making roughly the same core mortgage payment he started with decades earlier. Around year 12, Jake moves again. The landlord sells the building. Now he is apartment hunting in a market where prices moved faster than his salary. Every listing feels smaller than it should for the price. Every open house feels crowded. Back at the house, Marcus refinishes the kitchen. Not because he has to, because now the house actually feels like his. The walls hold memories, birthdays, Christmas mornings, height marks on a hallway wall. The kind of thing you can't take with you when the lease ends. That's another thing housing decisions change. Not just finances. Continuity. Jake moves again. More boxes. Another lease renewal. This apartment is smaller than the last one. The commute is longer now. And slowly, the flexibility that once felt freeing starts feeling temporary. Marcus's payment stayed mostly fixed, and inflation slowly made everything else more expensive instead. Trees got taller. Kids grew up. The place that once felt stressful slowly started feeling permanent. By year 10, Jake spent roughly $193,000 on rent. His investment account sits around $129,000. Marcus spent much more overall, but his home is now worth roughly $423,000. His remaining mortgage balance sits near $203,000. That leaves him with around $220,000 in equity. Same salary, completely different outcome. And the gap accelerates from there. Every year that passes, Marcus's balance shrinks, his home value climbs, and Jake's rent goes up. Jake is older now. Small apartment. $3,300 monthly rent. Silence. He opens the lease renewal and just stares at it for a second longer than usual. Not because he cannot afford it, because suddenly he realizes there is no finish line. Marcus opens his mortgage portal. Balance, 0. No applause, no fireworks, just silence. One payment ended. The other never did. And that's the real emotional difference between renting and buying. Jake thought he was buying freedom. Marcus thought he was buying stability. And for years, both of them believed the other guy was trapped. But Marcus spent years feeling trapped before realizing he had quietly built freedom. The trap is not renting. The trap is not buying. The trap is making a 30-year financial decision based only on what feels cheaper this month. Because monthly payments are temporary. Long-term math is forever.